I will be taking more positions in tech stocks. I might also consider making some speculative investments in companies like Zomato, Paytm, etc. Hey everyone, welcome to today's video. So if you analyze the tech stocks right now, there are some very troubling signs. For example, here is the chart for Paytm and it has fallen by roughly 40% from its peak and it has corrected significantly from its listing price. Similarly, here is the chart for Tesla and it has corrected by roughly 15% in the last 5 days. So the obvious question here is that are we in a tech bubble and is this bubble bursting now? What should we do with our tech stocks? So on this video, I'm going to cover 3 specific points. One is that I will discuss, are we in a tech bubble and is that bubble bursting? Second, what are some of the key things that you should remember while investing in a tech-oriented company or tech stocks? And finally, what is it that you should do in case you're already an investor in tech stocks? Should you pull out your money or is it a great opportunity to invest? So we will discuss these 3 specific points. Also, a very quick shout out to our sponsors for today, which is taxbuddy.com. It is an end-to-end solution platform for filing all different types of taxes. So check out the special link in the description box to avail that discount. Also, if you're sitting on a loss on your tax investments, you can offset that against your taxes. So you could consider speaking with the team at TaxBuddy. So let us quickly discuss that are we in a tech bubble? The short answer is no, that we are not in a tech bubble, but the asset bubble is deflating now. Now, what do I mean by this? So let me give you a very quick context here. So what happened in 2020 was that there was a lot of quantitative easing that was done by central governments all across the world. For example, the US printed a lot of currency. Similarly, a lot of countries took debt to deal with the COVID pandemic. So that money flowed into the economy. For example, the Indian economy, the US economy was flushed with a lot of cash. Now, what happens under such scenario is that almost all the asset classes, be it cryptos, be it stocks, be it real estate, all these asset classes inflate. Now, in this making of this bubble, the tech stocks benefited the most. For example, if you consider the growth of Amazon, Microsoft, Tesla, Zoom, everything shot up. Everything that has tech in it shot up. In fact, let me show you a very interesting graph. Now, this is the chart for TCS, Tata Consultancy Services, and this is the historic PE ratio of TCS. For example, the PE of TCS back in 2017 was roughly 20. Then it started climbing up and it was around 30 by 2018. And by the time COVID hit, during this entire period from 2018, 19 and 20, the PE was roughly at 25, right? Then what happened was that all the stocks tanked and then quantitative easing started somewhere here and the tech stocks reached a new PE multiplier. Now, tech stocks are trading at a very high PE multiple, which is roughly around 36, 37. You would not have seen me talking about PE on this channel too many times, but I'm bringing up the PE argument right now because tech stocks showed a very quick multiplier post-COVID. And as a result, the tech bubble actually grew really big in a very short span of time due to this PE multiplier. Now what is simply happening is that this bubble is deflating. Now I'm not saying that it will go back to this. That will not happen. But the point is that it will deflate a little bit and that is precisely what is happening in tech stocks right now. So this brings us to the second section where we will speak about the 5 key lessons that you should learn about investing in tech stocks, and I will use Paytm as a case study because there are a range of technology stocks and you will have to adjust your analysis before purchasing any stock. So let us pick the example of Paytm and let me give you some key lessons around the Paytm stock which you can apply to other stocks also. So lesson number 1 from Paytm story is whenever you are investing in a tech stock, please understand how that tech company makes money and whether or not it has the potential to make money. So here is the business model for Paytm and you will see that Paytm is involved in a range of things, right from travel booking to banking to Paytm cards to a bunch of different things. And if you go through this, your head will spin that how much work is Paytm doing. By the time I would be done shooting this video, probably they would come up with 2-3 new things that they would have added to this mix. So jokes apart, but the bottom line is that it is very difficult for us to assess the business model of Paytm since it is doing so many different things and it keeps on entering new and new businesses unprofitably. Now you would say that Akshat, you are doing a postmortem on Paytm. Where were you when Paytm was getting listed? Did you make any videos? Yes. Please go and check out my entire analysis of Paytm, and this is the exact same point that I made on that video which was published roughly 6.5 months back. That Paytm's business model is extremely confusing. If I ask you, right, as an audience, that please type in your response and explain me the business model of Paytm, where exactly is Paytm winning, which competitors it is fighting against, you might end up listing 80% of the companies that are there in India. So the bottom line is that please don't invest your hard-earned money in businesses where the business model itself has not been figured out. This brings us to the second lesson, especially in context of new age startups, because next year also a range of IPOs are coming, especially around tech startups. So it's a very important point. So please listen carefully that it is not always a good idea to go and run after IPOs. I have said it time and again that I am not a big investor in IPOs. I rarely invest ever in IPOs. And the reasons are this, and there are three specific reasons. One is that when you are dealing in IPOs, what happens is that you as a retail investor is going to have the least amount of information available. For example, the current investors who have invested in companies like Paytm, Zomato, etc., they would know a lot about what the company's growth expansion plans are, where exactly is it trying to capture the market, what specific strategy is it taking, how the financials have been made, all that stuff. But you as a retail investor will have the least knowledge at this stage. You might not even get quality financial information on the company itself. So therefore, don't operate with the least possible knowledge, and therefore generally avoid IPOs unless you are very, very sure that, hey, this is a fabulous company. Only then go and apply. Second reason why you must avoid IPOs, especially with tech-oriented companies, is that you don't know the real reason why the IPO is being launched. Companies in their IPO prospectus, they outline the reasons, but those reasons are very unclearly stated. So you don't know the real intent, why the company is raising that money, what it plans to do with the money. In majority of the tech stocks, barring a couple of tech stocks, almost all these companies are unprofitable and they are simply giving exit to existing investors. Even if we assume that the existing investors are not operating from a malintent, they are not trying to trick retail investors, what happens is that the holding sometime of good big investors might be like 10%, 15% of the stock, and they might find better investment opportunities. For example, a company called IIFL, when it exited CAMS is not a bad stock, but IIFL found more profitable opportunities elsewhere. So it sold off its stake in CAMS and the stock price came down aggressively, and then it reinvested that money in some other company. So this is the game that eventually plays out and it ends up hurting you as a retail investor. So please be very, very careful in terms of investing in IPOs. Please do it very sparingly and very sensibly. Now comes the third point, that please avoid story-based stocks. Now, what do I mean by story-based stocks? So there are two types of stocks in the markets right now. One is a cash flow business model oriented stocks where you know what the company is selling. For example, this pen, they sell it at 100 rupees. The manufacturing cost and sales cost and other cost is 50 rupees. So the profit on this pen is 50 rupees. That's a cash flow oriented company. For example, this could be Walmart. This could be HUL. This could be Coca-Cola. Very easy business model to figure out. The second type of stocks are called as story-based stocks. These are stocks like Zomato. Now, what is the story going on there? That, hey, you know what? That Zomato has a great delivery network. It will enter into groceries also. It will enter into urban company type of business also. It will replace school-going autos also. It will pick kids from school and drop them at school. I don't know, right? So probably they will capture all things that can be delivered, including kids from home to school. They will probably start doing that also. So those are story-based stocks. And in order for these type of stocks to succeed, those stories need to succeed. So you are taking a big leap of faith there. Now I get a lot of criticism because people give counter arguments that, hey Akshat, you know what? The tech stocks are story-based stocks and almost big companies. For example, Microsoft, Amazon, they were also loss-making at some stage in time. But guess what? They overturned and they became monopolies. Okay, so let us have a sensible discussion there. So for example, let's pick the example of Amazon. So Amazon, when it started out, it was a solid business model. Yes, it was loss making, but it was literally the first player that was selling books online at scale. Second, it was actively taking market share away from a company called as Barnes and Nobles, which was a big bookstore in the US, the biggest probably, and they were proving a very tough competitor for that particular company. The point that I'm trying to drive home is that Amazon had a sensible business model to begin with, and it was winning that race very, very clearly. Right now, Zomato is not winning the race. For example, there is a very close competitor called as Swiggy, and there can be multiple hyper-local delivery networks that could prove to be potentially more effective than something like Zomato. So the bottom line here is that this is not a stock buying or selling recommendation. All I'm simply saying is that whenever you are buying these story-based stocks, just understand that you are taking a big leap of faith here and that bet might or might not work out for you. Now in context of Paytm, for example, the indicators were very clear. Now this is the net loss the company is making, right? 1, 2, 3, 4, 5 years and loss, 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 loss. Okay, so what is the purpose of a business? The purpose of a business is if it is selling something at 100 rupees and if it is able to deliver that product at 90 rupees, then the profit is 10 rupees. At least some stage this should happen, right? Now, Paytm is not a very small company and these numbers are the ones that you looked at before investing. So please be sensible as a retail investor. Please don't do deep value investing like Mr. Mohinish Pabrai and Mr. Vijay Kedia. They have that nerve, they have that understanding to do it. We would not have that data and the acumen or the funds to play such a game. Now comes the fourth point. Now the fourth point and the most important point here for retail investors in tech stock is that please hedge your tech stocks. Now what do I mean by hedging? For example, let's say that you have a 100 rupee portfolio. Now only buy like 20 rupees or 30 rupees of tech stocks, right? Rest 70 should be invested in other cash flow oriented business where the business model is clear. So please don't go and invest 90 rupees in tech just because you feel that tech is going to take over everything. That is not sensible investing. You should be diversified across industries. That's point one. Even this 20-30 rupees, it needs to be spread across different companies. For example, if you invest your entire tech portfolio on Paytm, that is a really bad move. That just does not make any sense, right? Because if Paytm falls by 40%, now you are fretting that, you know what, I took like such a big position on Paytm, everything has fallen. So from that perspective, please follow a simple rule that please don't invest 5 to 7% of your money on any single stock, no matter how good that stock is. Because stocks, despite being really good, they can continue to trade at very low prices for a very long period of time because operators can play any game. So your only hedge as a retail investor is be sensible, be diversified and hedge your risks. Now comes the fifth and final point and learning on tech stocks that please don't do FOMO, right? FOMO means fear of missing out. Please don't do FOMO and please don't do panic buying or panic selling. Now let me explain that by taking you to Paytm's example. Now if you take a look at Paytm stock, it got listed at approximately 1550. Then it went down, people panicked, sold that stuff. Then it came back up. So the bottom line is that you should not have panic sold, right? Wait for it to recover a little bit and it always recovers. Now again, you will say, Akshat, you are doing a postmortem. Couldn't you have told us? I did. I made a short. If I'm able to find it, I'll paste the link somewhere here. You can go and watch it. So please don't panic sell in case the stock is tanking because it always recovers from that angle in case there has been a sharp correction. So it recovered, then people got supremely greedy, right? That, hey, you know what? Now Paytm is probably the next big thing and it is going to kill even Google, right? So we are going to hold it forever. Now you could have sold this stock anywhere on this range. You could have literally sold it anywhere on this range and people did not sell it. Now the stock has been tanking. Okay, so this brings us to the final section that, okay, now what we should do if we are holding tech stocks or if we are a new investor, should we go and buy something like Paytm? Okay, so this is a slightly more complex question for me to answer, but I'll still try to give it a shot. So point number one right now is that the undercurrent of the market is very positive. I don't think that we are going to see a very big correction from this point. That's point one. Point number two, tech stocks have corrected quite a lot. So I don't think that there is going to be a massive sell-off in tech stocks even now. The bubble has already reached a decent shape as per my understanding. Third and finally, should you be taking more positions in tech stocks? I would say yes, and I will be taking more positions in tech stocks. I might also consider making some speculative investments in companies like Zomato, Paytm, etc. I will do further analysis. Do let me know in the comment box and I will analyze and I will tell you how to do speculative investment. So I hope that you learned a lot from this video. Please press the like button and I will see you tomorrow.